Your money is an employee. Right now, that employee is sitting in a chair doing absolutely nothing, collecting a paycheck of 1.9% a year while inflation quietly fires them. What if instead you put that employee to work? $10,000, properly deployed, grows to over $300,000 in 30 years. And the beautiful part? You do almost nothing after day one. I'm not going to tell you to day trade. I'm not going to tell you to wake up at 4 a.m. reading earnings reports like some kind of finance monk. And I'm definitely not going to tell you to buy a hot stock your cousin mentioned at dinner. What I'm going to show you is the exact 3-layer system for deploying $10,000, automated, boring, and nearly zero effort once it's running. The same system that turns your money from a useless employee into the hardest worker you've ever had on payroll. Before we get into it, 3 myths. And these 3 myths are probably the reason your money is still sitting in that chair right now. Myth 1. Saving is safe. Investing is dangerous. This one sounds responsible. It feels responsible. It is not responsible. Here's the actual math. U.S. inflation right now sits at 3.3%. The national average yield on a 1-year fixed deposit is approximately 1.9%. That's a negative real return of 1.4% every single year. Your safe $10,000 isn't safe. It's shrinking. Over 10 years, that same $10,000 has the purchasing power of roughly $8,700. You didn't lose money on paper. You just watched it get quietly eaten alive. Inflation doesn't announce itself. It just shows up at the grocery store and makes you feel insane for buying chicken. That employee you left sitting in the chair? Inflation just cut their salary every year without asking. Myth 2. You need serious money to start investing. You don't. $10,000 is not a consolation prize. It's a legitimate launching pad. The amount matters far less than the system. Think of it like going to the gym. You don't skip the workout because you only have 10-pound dumbbells. You show up, build the habit, get your form right, and the weights go up over time. The mechanics are what matter, and the mechanics of this system are free to learn and simple to execute. Myth 3. Investing means staring at charts for hours. Not if you do it right. Here's a statistic worth burning into your brain. Retail investors underperform the market index by an average of 3% to 5% annually. The reason isn't bad luck. It's frequent trading and emotional decisions. The best performing portfolios are almost always the ones people forgot they had. The goal isn't to beat the market, it's to join it, get out of the way, and let compounding do what it does. You're not trying to be the smartest employee in the room. You're just making sure your money shows up to work every single day. So why $10,000 specifically? Because it's a psychological inflection point. Once your investment account crosses 5 figures and starts generating real cash flow, you feel, for the first time, what it actually means to have money working for you. At a 6% annualized return, $10,000 produces $600 a year, $50 a month, automatically, while you sleep, while you watch TV, while you're at the beach complaining about sunscreen prices. That $50 changes how you see money. It's not the amount, it's the proof of concept. The first time I saw automatic dividends hit my investment account, I just stared at my phone. It wasn't a life-changing sum, but I hadn't worked for it. I hadn't traded for it. I was completely checked out when it showed up. That feeling? It's like hiring your first employee and watching them close a deal without you in the room. Once you feel it once, you never think about money the same way again. Here's the system. 3 layers. Simple, mechanical, and designed to keep your emotions completely out of the equation. Layer 1. The safety net. $2,000. That's 20% of your $10,000. This money does not get invested. It goes into a high-yield savings account or a short-term fixed deposit. It sits there, doing almost nothing. And that is exactly the point. Most people don't fail at investing because they picked bad assets. They fail because an emergency hits, a car repair, a medical bill, a sudden job loss, and they're forced to sell their positions at the worst possible time, at a loss, in a panic. Your $2,000 safety net is what allows the rest of your money to stay in the market through volatility. Without it, you're running a marathon without knowing if there's a wall at mile 18. Think of this layer as the one employee you keep on standby, not producing, but ready to cover any crisis so the rest of the team never has to stop working. Layer 2. The growth engine. $6,000. That's 60%. This is the core. The objective is straightforward. Long-term, steady, compounding growth. No stock picking, no sector bets, just 2 types of assets. 70% of this, $4,200, goes into broad market stock ETFs. Think Vanguard's VTI, VOO, or a global equivalent like VT. These funds track hundreds or thousands of companies simultaneously. When one company stumbles, the index barely flinches. Historically, broad market stock ETFs have returned between 8% and 10% annualized over the long term. The remaining 30%, $1,800, goes into bond ETFs. Lower return, usually 3% to 5%, but they act as a stabilizer. When stock markets fall, bonds typically hold steady or even rise. The combination gives you growth without the kind of stomach-dropping swings that make people panic sell at exactly the wrong moment. These are your two hardest working employees. One is aggressive, chasing growth every day. The other is steady, showing up regardless of conditions. Together, they balance each other out. One more thing on execution. Don't try to time the market. Don't wait for the perfect entry point. Take your $6,000 and divide it into 6 monthly purchases of $1,000 each. This is dollar cost averaging. You buy at different prices over time and smooth out your average cost. Even professional fund managers with entire research teams can't time the market consistently. You're not going to do it by refreshing a stock app at 11 p.m. Layer 3. The Opportunity Fund. $2,000. The final 20%. This is dry powder. Flexible cash waiting for the moment the market hands you a discount. My personal rule: when the broader market drops more than 15% from its peak, I start deploying this fund in batches. Not all at once, in batches. What happens to this money in the meantime? It goes into a money market fund or short-term ETF, earning 2% to 3% while it waits. It's not idle, it's on standby. In 2022, when markets dropped sharply and everyone was either panicking or declaring the end of capitalism, I was deploying this exact fund. When markets rebounded through 2023, those positions gained over 30%. That's not brilliance. That's just having the ammunition ready before the opportunity shows up. Most people don't have that cash available when it counts because they didn't plan for it. You will. Now let's talk about what this actually looks like over time. A 70-30 stock-to-bond portfolio has historically returned between 6% and 8% annualized. Let's use 7%. Conservative, based on real historical data. $10,000 at 7% annually. In 10 years, you have roughly $19,700. In 20 years, $38,700. In 30 years, $76,100. Not life-changing on its own. But here's where the system compounds. Add just $200 a month on top of that initial $10,000, less than most people spend on subscriptions they forgot they signed up for. And your total after 30 years crosses $300,000. That number isn't theoretical. It's arithmetic. It's what happens when you stop trying to be clever and just let the math run. Einstein called compound interest the eighth wonder of the world. He wasn't being poetic. He was doing the math. Here's how you actually build this system, once, and then mostly leave it alone. Step 1. Open a brokerage account. This takes about 10 minutes online. ID and a bank account. Done. Look for low-fee, user-friendly platforms. Most major brokers now offer zero-commission ETF trading. Step 2. Set up automatic transfers. This is non-negotiable. Human beings are genuinely terrible at voluntarily doing the right financial thing repeatedly for 30 years. Automate the monthly purchase on the same day your paycheck arrives. Once it's running, you won't even notice the money leaving. It becomes invisible, which is exactly what you want. Step 3. Pick your ETFs, VTI or VOO for U.S. market exposure, VT if you want global diversification, a total bond market ETF for the bond portion. That's the whole list. You do not need 14 ETFs. You don't need to optimize this. You need to execute it. Step 4. Rebalance every 6 months. After 6 months, check your split. If stocks ran hard, your portfolio might be sitting at 80% stocks instead of 70%. Sell a little stock, buy a little bonds, restore the ratio. This feels counterintuitive. Selling winners, buying underperformers. But that's the mechanism of buying low and selling high built directly into the system. It takes 30 minutes, twice a year. Step 5. Keep learning, but stop reacting. Spend an hour or two a month reading about macro trends. Understand what's happening. Then don't touch your portfolio based on any of it. Knowledge for context, discipline for execution. These are two different skills and you need both. Here's the uncomfortable truth, and I'd rather tell you now than let you find out alone. At some point in the next 30 years, your portfolio is going to drop. Maybe 20%, maybe 40%. It happened in 2008. It happened in 2020. It will happen again. In some form, on some timeline nobody can predict. And when it does, every instinct you have will scream at you to sell. Don't. In March 2020, my account dropped over 30%. That feeling is genuinely awful. But I didn't sell because my asset allocation had bonds acting as a cushion, and because I had a system that already told me what to do. Keep buying. By the end of 2020, I hadn't just recovered the losses, I walked away with a solid profit. Here's the lesson from that. Your biggest enemy in investing is not the market. It's not inflation. It's not even a bad ETF, It's your own emotional response to volatility. The system exists precisely to override that response. When the market crashes, you don't have to make a decision. Your system already made it for you. One last thing that almost never gets said in these videos. Your investment portfolio is not your most valuable asset. You are. If you're 30 years old, making $60,000 a year and you work until 65, that's $2.1 million in earned income. Before raises, before bonuses, before any career growth. Every skill you build, every relationship you develop, every promotion you earn increases the capital available to feed the system. I have a friend who started with the same $10,000. At the same time, he invested hard in his own skills. Over a few years, his salary jumped from $60,000 to $120,000. Because his income increased, his monthly contributions increased. His wealth compounded faster. He's 38 now. His portfolio is over $100,000 and accelerating every year. The system multiplies whatever you put into it. The more you earn, the harder the math works for you. So don't just invest your money. Invest in yourself. They compound together. Let's make sure this sticks. 20%, $2,000, emergency safety net. High yield account, untouchable. 60%, $6,000, core portfolio. 70% broad market ETFs, 30% bonds. Deployed monthly over 6 months. 20%, $2,000. Opportunity fund, money market fund. Ready to deploy on 15% plus market dips. Automate monthly contributions. Rebalance every 6 months. Don't check it daily. Don't panic. Don't get clever. That's the whole system. This strategy won't make you rich tomorrow, but it gives you a real mathematically grounded path to financial freedom in 10, 20, or 30 years. Without daily anxiety, without staring at stock charts, and without losing sleep over whether you picked the right ticker. You set it up once. You automate it. You walk away. Your money goes to work. You go live your life. That's the lazy way. And it actually works. The best time to start was 10 years ago. The second best time is tonight. When you get home, spend 30 minutes opening a brokerage account or sit down and map out what you can realistically invest each month. Even $100, even $200. The habit is what matters first. The amount scales later. Remember, the employee analogy works both ways. You can spend the next 30 years being the only one working. Or you can hire $10,000 worth of help starting this week and let it work the night shift for you every single night for the rest of your life. So, are you still leaving your money in that chair? Drop it in the comments. Tell me where you're starting from. And if this gave you even one thing you can act on today, you know what to do.